Hello, and welcome to Pantry Talk Weekly, the podcast that breaks down the big business stories of the week. I'm Alec.
And I'm Zia. It's great to be here. Our goal is simple: to help you understand what's happening in the global economy using clear, everyday business English.
That's right. Think of this as a coffee break conversation about the news that matters. Today we're focusing on Asia, with three key stories on our radar.
Exactly. We'll be looking at the weak Japanese yen and what it means for global markets. Then we'll discuss the major new trade deal between India and the European Union.
And finally, we'll unpack the recent volatility in Indonesia's stock market. So, let's get started. First up, Japan. The Japanese yen has been in the headlines because it's been incredibly weak against the US dollar, hitting levels not seen since 1990.
Okay, so I hear the term weak yen a lot, but why does it actually matter to the rest of the world?
That's an excellent question. It all starts with the currency markets. These are global marketplaces where currencies are traded, like stocks. The value of a currency goes up and down based on supply, demand, and economic health.
Right.
When the yen is weak, it means you need more yen to buy one US dollar. This has a direct impact on trade. For Japanese companies that sell products abroad, think cars or electronics, a weak yen is great news. Their products become cheaper for foreign buyers, which boosts their exports.
So good for exports. What's the downside?
The downside is imports. Things that Japan buys from other countries, like oil and food, become much more expensive. This can lead to inflation and hurt consumers' pockets. It also causes concern about financial fragility if investors start to lose confidence in the currency.
That makes sense. So this has led to talk about currency intervention. What does that actually mean?
Currency intervention is when a country's central bank steps into the market to influence the value of its own currency. In this case, the Bank of Japan might sell its foreign currency reserves like US dollars to buy up huge amounts of yen.
To increase demand for the yen and push its price up.
Precisely. It's a powerful but risky move. It's also interesting to contrast this with the United States. The U.S. Treasury Secretary recently emphasized a strong dollar policy, stating they have no plans to intervene, believing the dollar's strength comes from solid economic fundamentals.
So different countries, different strategies.
Exactly. And historically, Japan has been a major source of investment abroad because its domestic interest rates were so low. Now that their rates are slowly starting to rise, it's causing ripples everywhere. It's a delicate balancing act. All right, let's shift gears from currency markets to trade deals. Our second story is about the major new trade agreement being finalized between India and the European Union.
This sounds significant, but let's back up for a moment. For our listeners, what exactly is a trade agreement?
Simply put, a trade agreement is a set of rules that countries agree on to make it easier and cheaper to buy and sell goods and services to each other. It often involves reducing or eliminating tariffs, which are basically taxes on imported goods.
So it's a rulebook to simplify business between countries. Why is this particular one so important for businesses and investors?
Well, the scale is massive. The EU is already India's largest trading partner, so this deal will supercharge an already huge economic relationship. Leaders on both sides have called it the mother of all deals.
Wow, that's quite a statement.
It is. For businesses, it means greater access to huge markets and more opportunities for growth. But there's also a big geopolitical angle here. In a world with unpredictable global trade, this deal is seen as a way for both India and the EU to strengthen their supply chains.
So it's about more than just money. It's strategic.
Absolutely. The goal is to promote economic cooperation and reduce their strategic dependencies on other major global powers. It's a classic example of using trade to build stronger political and economic alliances. For our final story, we head to Indonesia, where there's been some serious market turmoil recently. The country's stock market saw a sharp fall after a warning from a company called MSCI. To make matters worse, the CEO of the stock exchange resigned right in the middle of it.
That sounds like a perfect storm. Let's start with the basics. What is MSCI? And why does a warning from them have such a huge impact?
Great question. MSCI is what's known as a market index provider. The simplest way to think about them is that they create influential playlists of stocks that big international investment funds follow. For example, there might be an MSCI Emerging Markets Index, which is like a playlist of top stocks from various developing countries.
That's a very helpful analogy. So the big money managers just follow these playlists.
Correct. Trillions of dollars are invested based on these indexes. So if MSCI issues a warning that they might remove Indonesian stocks from a key index, it's a massive red flag.
Because if the stocks are removed from the playlist, all the funds that follow it are forced to sell them.
You've got it. And that triggers a massive sell-off, which causes prices to crash. It's a powerful demonstration of how quickly investor confidence can disappear.
And adding the CEO's resignation on top of that, why does a leadership change cause such a stir in that situation?
Because it injects a huge amount of uncertainty into an already fragile situation. Investors need to feel that there is stable leadership, especially during a crisis. When the head of the stock exchange leaves, it raises questions about stability and direction, which can scare investors away even more. Market stability is all about predictability and trust. So, that's a lot to take in. Let's do a quick wrap-up and review the key business English terms we discussed today.
Sounds good. First, we talked about Japan, and the key phrase was currency intervention.
Right. And to define that again, currency intervention is the action taken by a central bank to buy or sell its own currency in order to influence its value on the foreign exchange market.
Next, with the India-EU story, we focused on the term trade agreement.
And a trade agreement is a formal pact between two or more countries that establishes rules for how they trade with each other, often to reduce barriers like tariffs.
And finally, the situation in Indonesia highlighted the importance of investor confidence.
Yes, and investor confidence is simply the level of belief that investors have in the safety, stability, and future growth of a market. When it's high, money flows in. When it's low, money flows out.
That's a perfect summary. 3 very different stories, but all connected by the flow of money and confidence across the globe.
Indeed, that's all the time we have for this episode of Pantry Talk Weekly. Thanks for tuning in.
We encourage you to keep following the news, and we'll be back next week to break down another set of key business topics. Goodbye for now.